everybody, I'm Nick, and today we're going to be covering one of the coolest programs for investors called a DSCR program. DSCR stands for Debt Service Coverage Ratio, and the reason most investors like this program is because there are no income docs required in order to use it. So we're going to be going into a couple of details. I'll try to keep it kind of quick and hit on the main point. Let's get into it. Minimum FICO for this program is going to be at least 600. So I'm speaking from the perspective of my company. Other companies out there might offer something different. So you keep that in mind with all of these. But for us, it's going to be 600. You're going to see the best deals when you have 760 credit score and up. But it's not a deal breaker at all if you're anywhere in between. Right. So next point is going to be the DSCR ratio. So the national DSCR ratio average is about 1.2. You can search that up on Google or anything like that. What that basically means is, say the calculated payment that you would have to make on the property is about $4,000, and an appraiser goes to the property. They estimate that you could get about $4,000 rent from it logically, and you divide that estimated $4,000 by the $4,000 you have to pay. You have a ratio of 1. If you're above 4,000, then obviously the ratio goes above 1. And then if you're below, say you have the estimated rent is 3,000, then the ratio would be 0.75, 3/4, right? So for us, our ratios go as low as 0.65, right? That's pretty low. I don't see too many lenders who have that. But definitely check with your locals, anybody that you work with typically, to see if they offer that. It's a pretty huge deal in terms of making this program happen. So getting into some of the other stuff, what you're going to want to ask about also is the minimum and maximum loan amount on this program. So for us, I'm based out of California. I work out of a couple of other states. Minimum loan amount is $150K. Maximum loan amount is about $3 to $4 million. We make exceptions. It just depends on what's happening with the property, right? Other lenders obviously may be different. Rates are going to be important on this one too. So for the DSCR program, typically you're going to see rates at a little bit higher, and the reason that is because there's no mortgage insurance to pay on it. These are what are called alternative financing programs or non-QM programs, but basically there's no mortgage insurance to pay, so your payment is already starting out lower, so a higher rate is what you get in turn for that. So even with a 4.125 up to a 5%, you can still end up paying lower than you would if you bought the house with a conventional loan program, something like that. It's really cool. So the last two things that we're going to cover for this program are going to be proof of primary residence and reserves. So proof of primary residence, you need to prove that this isn't a home that you're going to go move into, but the way that you prove it is, well, they'll be looking for hazard insurance. 1 year of hazard insurance, or they'll do a verification of rent. So as long as you can clear one of those two things, you'll be good to go in terms of using this program. Something to remember also is that the banks might be looking for reserves. So typically between 3 to 6 months reserves. It just depends how high you're buying. If you're in the $1.5 million range and up, and you put 20% down, you might be looking at 6 months reserves. So if your payment would have been $4,000, then you'll want to show that you have $24,000 after you put all of your down payment and closing costs into this transaction. Last thing is the minimum down payment for these programs is 20%. Some people have it, some people don't. But if it sounds like you need a program like this, you don't want to show income docs, and you can save up and work to that amount, then I definitely suggest doing it. It saved a lot of deals out there, and it could save yours too. But that's it, guys. Like, follow, share, all of that, and I'll see you in the next one.